After putting in a high near $3 in mid-September, natural gas futures have slid to nearly $2.40. In fact, we may be in danger of retesting the summer lows in natural gas. As we scour the latest market sentiment polls and take a look at our trusty COT report, which is issued by the CFTC, it's clear to us that most speculators are still very bearish in natural gas, and this should come as no surprise. In the U.S., there's a long-standing supply glut, and domestic producers really haven't ironed out the kinks when it comes to liquefying and exporting the energy. Further, the state of California is actually proposing policies that would phase out the consumption of natural gas. In our opinion, this is odd because natural gas is a relatively clean fuel source, but nonetheless, it's an issue the markets have to digest. If you're looking at the very long-term prospects of natural gas, in our opinion, they're quite bullish. After all, U.S. politicians seem eager to ban fracking, and the practice of exporting energy or exporting natural gas is bound to improve. Accordingly, we tend to favor a strategy of getting bullish on large dips in natural gas, but not getting too greedy on the rips. Natural gas is a trader's market. It's not a long-term investor's market. It's not a buy and hold market. Those who forget that will pay a hefty tuition to the market for the lesson. According to seasonal stats put forth by our friends at MRCI, Moore Research Center Incorporated, natural gas futures tend to bottom in late October or early November. Obviously, this leaves us with a 2 to 3 week gap of potential weakness until seasonal support comes in. But as we know, seasonals aren't perfect. Even if the seasonal pattern materializes, some years it's early, some years it's late. But nonetheless, this is a good time to be looking for some sort of a flush out low or bottom in natural gas, at least in our opinion. The COT report, which again is issued by the CFTC, that's the Commodity Futures Trading Commission, is our go-to source of market composition information. We've mentioned it here before. This report depicts how various types of traders are positioned in the market. This differs from a sentiment index in that it tells us where traders have actually put their money, not just their mouths. At the moment, speculators are holding a relatively decent-sized net short position, but it's not nearly as extreme as what we saw in July and August. So in our view, what this tells us is we did get some significant short covering from the August lows to the September highs, but those traders are probably in the process of putting their shorts back on, and we're not sure they're quite done yet because we haven't reached those max levels that we saw a few months ago. In other words, the bears still have some ammo. Going to the chart of natural gas, we're using the December natural gas futures contract. Some argue that natural gas is currently cheap, but I argue otherwise. Not being expensive does not necessarily translate into being cheap. Natural gas futures haven't spent a whole lot of time below $2, so in our view we can use this as some sort of a floor. That said, it's not impossible for natural gas to go under $2. So any trading strategy or investment that you may or may not take should account for the possibility, but not likely, event of natural gas seeing $2. Instead, we're looking at support from $2.33 to $2.25. We probably wouldn't start turning bullish until $2.25. This gives the market a little room below the recent lows, stop running, market squeezing, long squeezing, that sort of thing. But with that said, if $2.25 is seen, we do feel like it would at least generate a temporary bounce and maybe even something more if seasonal support comes in.